Hello, welcome to this lecture on renewable energy markets, trading, risks and strategies. My name is Derek Kolen and I will be happy to tell you today a few things about 1. How renewables are changing market dynamics in global power systems, 2. Which risks are involved for different renewable market parties, and 3. How renewable market agents may hedge and manage such risks. This lecture aims at giving you a good general understanding of these topics, give some renewable market insights and help in recognizing ongoing market trends. In this lecture, we will first discuss ongoing trends in energy systems driven by ambitious climate targets to achieve net zero emissions. Next, we will explore on how such trends affect energy market dynamics and trading. And finally, we will look into market risk management for renewables and how renewables can survive in open markets with merchant risk. Shortly about myself, I'm currently a project officer in clean energy integration at the European Commission, where I mainly work on key projects that support the delivery of the EU Green Deal in achieving these net zero climate targets. My main topics include EU power and gas markets, the rollout of EU hydrogen networks and enabling investment, and the deep decarbonization of energy-intensive industries, as well as enabling EU hydrogen infrastructure investments. Before joining the European Commission, I worked as an energy risk analyst for German-based Encavis, one of Europe's leading renewable investors and IPPs, and as well as a renewable portfolio manager on the trade floor of a major Dutch utility, where I was mainly responsible for managing the position and exposure of almost 5 gigawatts of wind and solar farms. I hold a PhD in energy economics from Erasmus University and I have a background in energy engineering. I would like to start setting the scene by looking at some headlines that have popped up in recent news outlets. Governments around the world are recently announcing ambitious climate targets and plans, most notably in this article by The Economist, which discusses the return of the United States to the Paris Agreement, as they announced targets of a 50% reduction of greenhouse gases from 2005 by 2030. Similar targets have been announced in Europe, with an even more ambitious announcement recently, just this month actually, of the Fit for 55 package, aiming to expand the current emission trading scheme to the building and the transport sector. A cornerstone pillar in achieving such challenging targets is obviously the transition of the power sector, as decarbonizing current electricity systems account for roughly 1/3 of the way to net zero emissions. And sectors like transport, buildings and industry rely heavily on deep electrification powered by renewable energy sources. So what's happening today? On these two websites, you can see live data on the carbon intensity of electricity in areas around the world. And as well, on the other one, the production of renewables in the Netherlands. We won't be able to cover them in detail in the interest of time here, but I invite you to take a look and, for example, compare a windy and a sunny day with a wind still or gray day, and you'll notice quite some differences on these live data schemes. I'll give a practical example with energieopwek.nl on how renewables can influence market prices in the second part of this lecture. But first, let's further get into how the mix of such different production technologies may affect energy market dynamics and prices. For that, basic economics teaches us we need to look at how supply and demand functions. The supply function on the figure, represented here, portrays the merit order curve of the different production technologies in a typical electricity market, where producers are willing to offer electricity for at least their marginal costs. Note that the gas and coal production obviously bear fuel cost, where renewables do not. And as such, the step curve with the different trading technologies is created. With the increase of renewable energy sources, the supply curves move to the right, as more low-cost producers are introduced on the market, and the so-called merit order effect may put more conventional units out of business. This graph, for example, shows the correlation of the German day-ahead power price to clean gas and coal prices, whereby clean is the price base for the commodity, considering also any surplus costs for carbon taxes, etc. It is important to note that whereas gas producers may not so much be exposed to the gas price due to incorporate margins. For a low-cost renewable power plant operating in a market where the power price is set by such a gas plant operator, the largest commodity risk may actually be that gas price. To further understand these markets, price developments and trading behavior, let's take a more practical look at how energy is traded. Here you can see what a typical trading screen of an energy trader looks like. We are looking at the gas trader, which has access to some of the major virtual trading points in Western Europe. namely the NBP in the UK, Zeebrugge in Belgium, and TTF in the Netherlands. Like for power, the commodity can be traded via different forward contracts, which agree to deliver a specific amount of energy at an agreed time in the future. For example, the next day, the weekend, the next month, various quarters, seasons, and years can be traded. Note that as one moves further towards the future, the market becomes increasingly illiquid. The market dries up, so to say, as there are fewer bid and ask offers further in the future. Most liquid trading takes therefore place up to 3 years in advance, which, as you can imagine, may already create business case challenges if you want to build a wind or solar plant, which has an operational lifetime of typically at least 20 years. As the trading platform already indicated, one can trade a commodity at various future points in time. Trading thus takes place in several so-called sequential forward markets from several years ahead, typically via bilateral contracts instead of an auction, to months, weeks, and day-ahead contracts, which take place in an auction. For electricity, the latter is the most liquid market, the day-ahead market, although most power is already sold or hedged upfront via forward contracts, as these allow to adjust any portfolio nominations close to real time. In the last several years, intraday markets have seen to start to play a bigger role, which allow to deal with supply and demand deviations even closer to real time. It is important to note that as the share of renewables keeps increasing, more trading is moved closer to short time markets, as it allows to hedge better close to real time. The intermittent behavior of renewables, where predictions are only relatively acceptable on the day-ahead level, is the driving factor behind this. As a general consequence, short-term markets become increasingly volatile. The graph here shows the weekly spread, and that is the delta between the highest and the lowest price for the imbalance, or real-time, price and the day-ahead market. We see that the spread is much larger for the imbalance markets, obviously as deviations are dealt with in real time, are much more volatile, but also that the spread is increasing over time for both markets, and most clearly and most pronounced for the market that is closest to real time. This is not because these markets become illiquid, but rather that next to the uncertainty on the demand side, increasing uncertainties on the supply side drive volatile behavior of short-term prices. This concludes the first part of the lecture, in which we looked at the general market trends and the decarbonization of the electricity sector, as well as how power is traded in sequential market. In the second part of the lecture, we will look more specifically at a renewable business case and how investors and developers can deal with the associated financial risks.